In this video, we look at the ongoing battle between inflationary and deflationary forces, with a focus on the negative aspects of excessive money printing by the ECB and Fed. This is part one of a two-part video. In part two, we're going to look at charts, really, and key market levels. We'll look at some scenarios, and from a fundamental perspective, in part two, we're also going to look at the theory of decoupling. In this video, we're going to go over this flow chart here, and we'll start with important dates that we need to keep an eye out for here in the first quarter of the year. We've got a Fed statement coming up on January 25th. It's possible that the market will hold up better than we think until then, because the market is always hoping and praying for more money printing, and Fed governors in recent weeks have been, what a surprise, alluding to the fact that they may be willing to print even more money. We've got another Fed meeting on March 15th. The most important date to put on your investment calendar is March 20th. We've got some huge bond redemptions in Greece, and we'll talk about that a little bit on the next slide. And of course, we've got an election coming up in the United States. We've also got elections in Europe this year, and that may also make it more apt for the Fed and the ECB to continue to print money. You can pause this and read it if you like. This quote encapsulates why March 20th is important. We've got bond payments coming due in Greece. The question is, there's negotiations going on between Greece, the IMF, and the creditors. And the question is, will there be a voluntary 50, 60, 70% write-down, which would be a quote-unquote orderly default, or will those parties not be able to come to an agreement and we'd have a disorderly default, which would be considered to be a credit event? Why that's important is if they don't come to an agreement and we get a disorderly default and a credit event, that would trigger what's known as credit default swaps, or CDSs, which are just strictly insurance claims against default. There's only somewhere in the neighborhood of 3% of the bonds outstanding from Greece have insurance, and the vast majority of that insurance is held by hedge funds, and their thought process is fairly logical. Why would I want to take a 50, 60, 70% haircut when I thought ahead and paid for insurance, and if there's a default, I'm going to get 100 cents on the dollar? The banks in Europe, which have huge exposure to all European bonds, tend to be the ones that don't have the insurance. So if there's a hard default or a credit event, obviously it's going to impact their balance sheets. We talked about this before in a previous video, just want to touch on it again. This is potentially a game changer in the short term. This is the European Central Bank's balance sheet. You can see here, late after Thanksgiving in 2011, they flooded the system with money and credit, and this is basically somewhat of a controlled form of quantitative easing. It's money printing. You can call it whatever you want, but it's money printing. They did similar things in 2008. And as we mentioned in the previous video, we want to just keep in mind that this is the Fed doing the same thing in 2008 with currency swaps, flooding the system. You've got this vertical move in their balance sheet. But again, we just want to remind ourselves this is potentially a game changer in the present day, but it may not be a game changer in the short term. When this occurred in 2008, the S&P 500 fell 45% after they flooded the system with money and credit. In the previous video, we also talked about this chart. If you want to find it, we're not going to go over it again. You can just Google Shivako Capital Channel and then find the video that has a thumbnail of a flow chart that looks very similar to this. This is what we're going to go over now. With the ECB expanding their balance sheet in the way that we just showed you on the graph that had the red line on it, what we've basically come down to here, and this may sound a little bit harsh, but our financial system has become more and more dependent upon central planning, which is a term that I hate because it's the opposite of free markets. You've got a lot of intervention going on with the Fed and the ECB on an increasing level. Again, that chart that we showed you shows the increasing frequency and the dramatic moves that are being made by central bankers. You can somewhat simplify the situation now. What we've got is insolvent central banks working with insolvent commercial banks and brokerage firms, and they in turn are working with insolvent governments. Now, you may say that the term insolvent is a little harsh. Well, what is on the balance sheet of the central banks? A bunch of assets that nobody wants. Italian bonds, Spanish bonds, bonds from Portugal, etc. Are the banks insolvent? What's on their balance sheets? Same things. A lot of assets that are questionable whether they're going to pay off. Bonds from Greece, Italy. And in terms of the governments being insolvent, if you can't pay your bills and you're reliant on borrowed money to pay your bills, and if you can't borrow any more money, then that's basically the definition of insolvency. If I were running a household and I could only pay my bills if I could borrow more and more money, at some point, if someone won't let me borrow money or borrow money at reasonable rates of interest, then I become insolvent. So what's happening now with the 3-year loans, which are unprecedented by the ECB that they're making? The ECB is basically printing money. They're giving it to the insolvent banks around Europe. And in turn, they're posting risky bonds. And when I say risky bonds, that means bonds nobody wants, as collateral with the central bank. The commercial banks are taking the printed money from the ECB and doing two things with it. One is they will potentially use it for their own bond payoffs. They have bonds that mature in 2012, and it's very, very difficult for these banks to access the private market, and that's one of the things that we talked about in the previous video. So the money that the ECB is giving them is going to allow them to pay off their bonds without potentially having to default themselves. The other thing that they're doing with the printed money from the ECB is the governments have the same problems. They have bond redemptions coming in 2012. They need money to pay off their existing investors when those bonds mature. So the printed money is flowing from the ECB to the insolvent commercial banks. They in turn are helping the insolvent governments. The governments give them more risky bonds. That might be an Italian bond, a Spanish bond, etc. And then they can then post those risky bonds, the bonds that nobody wants, as collateral at the insolvent ECB, and they can give them even more money. They came out with a huge amount of 3-year loans late in 2011. They're also planning to do this again in February of 2012. So what you've got here is the insolvent central banks, the insolvent commercial banks, and the insolvent governments basically bypassing the traditional ways that they would raise money because the private markets really aren't interested in giving them money. And the sad thing is, and we would ask you that if you agree that what's going on with the central banks is a little bit over the top, we would ask you to forward this video to some people. Part of what we're trying to do here is to get the word out to individuals, hardworking people, voters. We believe central banks have overstepped their bounds, and this is getting ridiculous in terms of the amount of market intervention that's going on. What this allows the insolvent governments to do, they have printed money. The printed money can keep these lavish entitlements that we have in Europe and in the United States. It allows the governments to continue to control or not control their spending. And it allows leaders to avoid making hard decisions. If the central banks just keep relenting and printing more and more money, why would a European leader or a Democrat or a Republican in the United States have to make a hard decision? There's no need to make any hard decisions. The central banks will print money and we'll all be fine. Why would a commercial bank in the United States or Europe ever worry about problems with their balance sheet or worry about making risky loans when they know that the central bankers will print money and bail them out. That's what's known as moral hazard. The other thing that's frustrating about it is this whole system of printing money also helps the current leaders in Europe, in the United States, and the people that run these banks stay in power. How is that? Well, when you keep putting Band-Aids over the situation, you can create a situation where it looks like they have come up with quote-unquote solutions. And these can be solutions in the short term. It's the long term where it becomes extremely questionable. And meanwhile, as they print money, hardworking people in Europe and hardworking people in the United States, hardworking people in the UK, all over the world are getting an indirect tax, a tax that they have no way to offset. They're not being represented. And that tax is in the form of inflation. And we have inflation showing up already in gas prices and energy prices. And if they keep pumping more and more printed money into the system, eventually that indirect tax in the form of inflation will get worse. The other concern that we have, and one that a lot of people may not be aware of, it sounds like, no harm done here, printing money, not really harming anybody, but ultimately what you're doing here is you're transferring these risky assets, these bonds, from the balance sheets of private entities like commercial banks and brokerage firms, and you're taking the assets that they don't want and the dirty laundry, let's say, and transferring that from the balance sheets of the private sector to the balance sheets of the taxpayers. And how is that? Well, if you're moving these risky assets off the books of the banks and brokerage firms and moving it onto the books of the central banks, ultimately the central banks, the ECB, the Fed, are backed by taxpayers in Germany, France, United States, so on and so forth. And these banks and brokerage firms took risk and they were compensated for that risk. Now when they're running into problems, they're really not paying the price or the consequences. And while all this may seem harmless, ultimately, if there's a problem and the ECB runs into problem with all the garbage debt that it has on its balance sheet, guess who's going to have to step in and bail them out? Taxpayers. Graphically, to understand why the risk is being transferred and how it's being transferred, this spike in the ECB's balance sheet, and the Fed's done the same thing, so we're not picking on the ECB here. This spike is the transfer of these assets that nobody wants onto this balance sheet. The ECB is taking on Italian bonds, Spanish bonds, bonds from Portugal. And in the United States, the Fed's bought all kinds of mortgage-backed securities that nobody wants, and they buy a ton of treasuries. And the problems are becoming acute. Just recently, in January of this year, the Fed, the Treasury, I should say, just recently auctioned off $13 billion in new Treasury bonds. And that's so the government can continue to spend money it doesn't have, and so the government can pay off treasuries that are coming due. In that auction, out of the $13 billion of treasuries that were put into circulation, the Fed bought 61% of those bonds. That's an alarming number. We're not the only ones. If you question our sanity here, this is PIMCO's Twitter account. On January 12th, Bill Gross tweeted that the recent putrid long bond auction shows that the only investor that wants 30-year treasuries is the Fed. And it's borne out in these numbers that the Fed bought 61% of the bonds that were auctioned off. And this is what's known as monetizing your debt, and it's what's known as pure money printing. The other thing that's concerning is you'll also notice this shot here, if you want to read this, from Bill Gross at the leaders from Greece. And I think what you're seeing is increasing frustration and friction between money managers and Wall Street and central bankers. It's very, very difficult for bond managers or stock managers to do what they need to do when the central bankers are printing this much money and changing the rules on a dime. And another negative consequence is that we're destroying the free and private markets, and they're being replaced with centrally planned markets. Something else I want to mention is this inflation tax here and all the money printing that's going on. Who is the Fed and the ECB really hurting? They're really hurting someone that's worked their whole life and saved their money and really isn't interested in taking risk anymore. They're looking to put their money into CDs or what used to be termed risk-free bonds. They don't want to take risk. Well, when you lower interest rates to zero and CDs are paying next to nothing, you're forcing people that may not want to take risk. They feel like they have to take risk to get some type of return. And the other fear that they have is if they just stuff their money under their mattress, they feel that future inflation with all this money printing could kill them. So from an ethical and moral perspective, we have to question, why would the Fed want to force anybody to invest in risky assets that they're not interested in investing in? And we know the answer to that is the other place that this printed money goes. And if you find on our website our QE2 videos, it also floods into the financial system, and they try to boost asset prices, the price of bonds, the price of stocks, the price of real estate. You could make an argument and say, well, Chris, they're really not printing money. These are 3-year loans, so that money's going to be pulled back out of the financial system, and they'll give back those assets that you consider to be risky. Well, my argument there would be we were told the same thing in 2008 when they flooded the financial system. And my counter argument would be, do you ever see on this graph where the ECB, look at the same thing for the Fed, ever shrinks its balance sheet in any significant way or ever takes risk off of its balance sheet and returns it to the private sector? I would say the fact that this chart has gone from here to here says the answer to that question is no, with a capital N and a capital O. This was PIMCO's CEO again. He wrote a piece on CNBC.com talking about the recent European downgrades. And he uses the expression that the ECB is willing to contaminate its own balance sheet. This is the balance sheet contamination that we talk about. And I would argue that he could have said own is kind of hides the fact that really you could say contaminate the taxpayers' balance sheet from Germany and all the EU members. And if I live in Germany or any of the EU countries, I'm not real pleased about this. And the ECB saying that they don't print money, it's laughable when you look at this chart. Well, they're only 3-year loans. Well, what prevents them from perpetually offering 3-year loans? And we probably all know that that's coming. If there's a problem now in 3 years, they'll just continue to let this balance sheet balloon. This is uncharted territory that we're in, and I can promise you that if this goes on unchecked, it will end badly. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.